All right, everyone, we will be getting started here in a moment. If you do have any questions, make sure you type those into the chat box. Everyone's audio has been muted on your end, so make sure that you do type those questions in if you do have any. It is 11:57 showing on my clock, so we'll get started here in a few minutes. Let's let everyone get signed on. This won't be necessarily the longest presentation day, probably about 45 minutes or so. I'll certainly will be open for the hour if anyone has any questions. But go ahead and type those in if there's any that you want to get in there beforehand. We'll be asking those, or we'll be answering those as they come along. Is there a download, handout to download? Actually, yes, we can do that. One moment, Bradley. All right, I am showing that it is 12 o'clock Eastern time, so we will go ahead and get started. Remember, anyone, if you do have a question, type that into the chat box as all of your audio has been muted. I will certainly do my best to answer any questions to the best of my capacity. I will read a disclaimer here in a moment that we are not tax advisors. So again, this will only get into some higher level things, some a little bit more theoretical applications of unrelated business tax and unrelated debt finance income tax as well. But again, ask a question. If I am able to answer it, I certainly am happy to do so, or I can give you a referral or maybe some other resources to utilize. So with that said, go ahead and get started. My name is Alex Perny. I'm a business development specialist here at Advanta IRA. I've been here since 2012. I've been involved in over 1,200 different deals, specifically here at Advanta. So I have a lot of experience in kind of looking at different deals, seeing when things have had UBIT and UDFI liabilities applied to them, some when they maybe haven't necessarily had it applied. So again, ask a question if you want to pose a deal. Certainly happy to take a look at it in this capacity and see if something would trigger, at least my inclination as to whether or not that maybe would apply. But just to kind of forewarn everyone, some of this stuff, especially when it comes to UBITs, the unrelated business income tax side of things, is a little bit less clear. The IRS doesn't necessarily give the most specific guidance on it. I will give you the exact Internal Revenue code publication that you can look at when it comes to trying to define a UBIT liability, but it isn't always necessarily as clear as them just saying yes, no. There is a little bit of ambiguity in there. So again, keep that in mind. If you have a question after this, feel free to give me a call or shoot me an email. Contact information is right there on your screen. Now, an important disclaimer, especially today, since we are going to be covering the application of a tax specifically to IRAs and the like, the Advanta IRA and our employees do not provide investment advice or endorse or promote any products. All informational and materials are for educational purposes only, specifically regarding taxation, and all parties are encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of investment. Pausing a little bit. Okay, a little bit about Advanta IRA before we get too far into it. We have well over 20 years of experience in self-directed IRAs. We currently administer about $1.8 billion worth of assets under administration for our clients. And with regard to administering client accounts, we like to have a very personal touch. We have a dedicated client account manager program. So every single person with an account here at Advanta has a dedicated representative that they can contact and ask. You're not going to be getting a phone bank every time you need to have something done, whether it's a specific question on an investment that you're doing or specific to your account or anything else. You always have the same person you can call and get. I did that job for about the first 5 years that I was here at Advanta before transitioning into my new role. So keep that in mind, is that if you are looking to start an engagement with the self-directed IRA custodian, we're not all created equal. We like to have a very hands-on approach and provide you with good education so you can do these types of investments with the most knowledge going forward. Okay, so we have a question, and again, please, I'm very happy to answer these questions as they come along. I am of the opinion that I like and the style that I will do them intermittently throughout, so don't feel like you need to wait till a specific point to ask them. Before we kind of specifically jump into the plans that are subject to UBIT and UDFI, we have a question from a listener here. It says, for brokerage, held multiple units in an IRA, is not brokerage supposed to be deduct prior losses from the MLP before calculating on 990T for client? With regard to that, if you could please expound on the use of the MLP in that context. If you could just maybe expound a little bit more on the specifics of that. I think I have an answer for you, but maybe just type that out a little bit more long form. Now, plans that are going to be subject to this tax, again, unrelated business income tax and unrelated debt finance income tax are the two components that we're going to be talking about here today. Now, some people might be under the impression that some plans are completely exempt from this. That's not the case. All of these plans can potentially have both, some or none of these applied to them, depending on how they're structured. But keep in mind that all of these plans do have the opportunity for you to have these taxes apply. So whether it's a traditional IRA, a Roth IRA, SEP IRAs, even solo 401k plans or qualified retirement plans can have these taxes applied to them. These taxes are going to be applied outside of the taxation that would be necessarily due on a distribution, or the taxes that you might be front-load paying if you're doing an after-tax contribution into something like a Roth IRA. These are taxes directly associated with the actions of this retirement plan and are due and to be payable by the retirement plan as well. So when we're talking about these types of taxes, there is a tax return that you have to file called 990T for the specific plan that it applies to. But this is not something that you pay personally. It is monies that have to be paid by the actual plan itself. So if you had a UBIT liability in something like a Roth IRA, while Roth IRAs don't have any taxes on qualifying distributions, the Roth IRA actions or the type of investments that it engaged in might have a taxable liability associated with it, and that Roth IRA would have a tax to pay. So it's not something that you're filing against your personal taxes. All of the filing and any type of deductions or credits or anything else like that that might help to mitigate a taxable liability for one of these plans would be solely based on the engagement of the actual plan itself, not something that you have done personally. Let's see. Okay, we got a question regarding this. Purchasing publicly traded in their brokerage IRA account, those entities throw off UBIT. Some years when UBIT exceeds $1,000 per account, the 990T is due, but we thought clients' UBIT losses from prior years could offset against UBIT gains before calculating the high tax on 990T. So yes, what essentially this individual is asking is that if you have an investment that is throwing off unrelated business income tax liability, and we'll get to this in a moment, you don't have to file a UBIT return if the liability, the gross amount of income subject to UBIT is less than $1,000, not necessarily just the liability associated with that. So some tweaking might need to be done in calculating whether or not that the $1,000 per account in this scenario would hold true. But yes, if you do have a loss and you had filed and you are tracking that loss, then you would potentially be able to take it in a future year. With that said, I do need to disclaim, you would specifically need to talk to an accountant that could actually look at that on a micro level to make sure that any type of losses that can carry forward are being able to be carried forward. And if there's any special requirements for doing so on filing 990T, that those types of requirements are followed as well. So with that said, let's get a little bit more into what specifically is UBIT. So UBIT is unrelated business income tax. And the best way I can describe this in a very easily digestible way is kind of a leveling the playing field tax that the IRS imposes on these great tax shelters, which are IRAs. So IRAs get inherently great tax benefits from investing through them. However, if you were to do some activities, you might be able to create a significantly bigger advantage to other types of entities in a particular industry, namely operating a trade or business. So if your IRA goes out and buys an active trader business, think about it if it were to go buy a laundromat. If you had an IRA that bought a laundromat and never had to pay any taxes, well, that would be a significant advantage on the marketplace of really anyone else out there, and could create a rather sizable tax loophole for anyone to engage in. So the UBIT tax is levied as a way to kind of level the playing field and make sure that these tax sheltered accounts, so IRAs, Roth IRAs, 401ks, aren't just able to go out and just avoid ever paying any taxes. So when I say trader business, that is unfortunately not as well defined as we would really like, especially from Internal Revenue Code 512B on what exactly constitutes a trader business. If your IRA is selling widgets, then yeah, that's a relatively easy one to define. But a lot of people will ask, and they'll say, hey, my IRA, might buy and sell 2 or 3 properties in a year. Is that a trader business? Well, probably not. If you're looking at it from that standpoint, if you personally were to buy or sell, 1 or 2 properties a year, would you need to have a dealer's license or a broker's license for many things? Typically not. So, using those kind of litmus tests, you can kind of make a correlation between the two of where you might need to have licensing or additional reporting personally might translate. But unfortunately, the IRS doesn't necessarily give us a great playbook of saying, hey, here's exactly where you demarcate and say, yes, you have a UBIT liability. Now with unrelated debt finance income tax, the line's a little bit clearer. So the nice thing is that if you are using debt and you have a concern there, then it's a lot easier to identify when you're going to have that type of issue. Now, common areas where IRA investors encounter UBIT are when investing in LLC membership, tax is a pass-through when the entity sells goods or services. So a lot of times people will use IRAs, especially at Advanta, to invest in things like startup companies, or if they have a friend or someone that needs some capital and they want to help and maybe invest in that particular entity with their IRA. Well, depending on how you structure that particular investment, you might be directly exposing your IRA to UBIT. If you were to purchase, let's say, LLC membership directly into a restaurant, or let's say a place that sells auto parts, for example, and you were to buy LLC membership directly in that as a pass-through, it's not taxed as a C corp, then your IRA, by virtue of having an equitable stake in a active trader business, would have to pay UBIT taxes on what it's receiving back, so long as that's over $1,000 of gross revenue per year. Okay, looks like we got a question. Okay, DW asks, isn't real estate subject to UBIT if there's debt on the property? So the answer is yes and no. Is it subject to UBIT specifically? No. Is it subject to a subset of UBIT? Potentially yes, which is unrelated debt finance income tax, which is specifically what we're going to get to here in one moment. So yes, that's kind of coming a little bit later with regard to that. But keep in mind is that the 2 types of taxes that we're talking about both fall under the same kind of regulatory cap of unrelated business income tax. But specific to that, there's one just related to debt, which is UDFI, or unrelated debt finance tax, which we'll get to in a second. Let's see, Abbas asks, how about operating an Airbnb out of a Roth IRA? Again, it's not necessarily something that is clearly defined by the IRS. They leave things a lot of the times very intentionally vague with regard to that. Is operating a short-term rental on a property considered an active trader business? Well, how many times are you renting it out a year? I would highly encourage you to get with a CPA or an attorney that can specifically look at that is familiar with 990T filings to see if they think that it creates a UBIT liability. I would think that it definitely inclines you a little bit closer to having one, but it doesn't necessarily automatically drop you into the bucket of needing to file a 990T. But again, the prevailing thought is that if you think you might need to, check with a CPA or an attorney that can give you a definitive answer. Let's see, and then before we go too far on, we have one last one from Valerie. Does UBIT apply to general cash savings used to invest? No. So that kind of actually segues very well into my next point, is what is considered investment income. So income that is generated from rental real estate, note interest, dividends, royalties, capital gain income is not considered subject to UBIT. So UBIT is going to be subjected to business income, unrelated business income, because the business is unrelated to the nature of the tax shelter that you have this investment in, be it the IRA. So holding a trade or business is what will generate that type of tax against the revenues. Now, investment income is generally considered exempt from UBIT. Now, again, investment income, things like rental property income. Again, remember generally, because if maybe if you're doing a short-term rental, that might fall into the other category. But generally, rental real estate, note interest, so principal and interest payments on a note, dividends, royalties, and those can be royalties from any number of things. We've seen royalties from land contracts with oil and gas, a lot of other different stuff, and then capital gain income, and that's a little bit transitioning into the security side of things when you have the sale of a security that maybe has a loss, or sorry, that has a gain attributable, would not be considered subject to UBIT. Now, certain public securities do have UBIT liabilities that you need to be aware of, but in general, if you're just going to be buying a general equity on a stock market, the reason that those don't pass on is namely because they're C corps. You know, you're not buying into a private limited partnership that's going to have a pass through to it. Everything's going to be taxed at the corporate level. A lot of people like to call this type of structure a blocker entity. You know, if you're going to be investing on a more micro level and you're instead of using an LLC, I like to be taxed as a C corp, and I'll show how that might have an advantage or disadvantage depending on what type of returns and what type of write-offs you might have against that property. Something to keep in mind. Let's see. Another question is, or cash invested in syndications where UBIT applies to IRA accounts? Well, in this case, if you're talking about leaving uninvested cash in a particular, let's say, limited partnership and not returning it back necessarily to if they're not doing distributions on a quarterly or annual basis to, let's say, the limited partners, the cash there wouldn't necessarily be subject to it, but any returns that they are paying that they're going to have to report back on Schedule K1 to show the distributions paid to the shareholders of that entity would be potentially subjected to UBIT or unrelated debt finance income tax. But again, then that's also going to be predicated on whether or not, at least for something like a syndication, which are typically done as limited partnerships, whether that underlying syndication is utilizing debt. Now, I would say probably 90% of the time, if you're investing into some type of limited partnership syndication, there's going to be debt. You know, rarely are you going to be getting into a limited partnership that's going to raise enough capital to buy, you know, tens or 20s or hundreds of millions of dollars worth of real estate in cash. So that underlying debt would pass on a debt finance income tax liability to the actual shareholder. But great questions. And again, some of this kind of comes with the answer of not sure, but it's definitely good to understand that there is possibilities out there. And that's what I want people to take away, is understanding that certain scenarios, while not necessarily black and white as to whether or not something would apply, does kind of beg the question of, hey, I need to look at this a little bit farther. Now, we had a question earlier regarding debt. Now, this is the portion of UBIT where it's slightly different than the trade or business, because it focuses strictly on whether or not that there is debt involved in the acquisition of a asset underneath of an IRA or retirement plan in general. So UDFI is unrelated debt finance income tax, and this can apply to when a retirement plan uses financing to acquire an asset, or when the underlying entity, such as a limited partnership, utilizes debt, and this isn't the case when it's passing through. So a LLC taxed as a LLC, or a limited partnership that taxes a partnership, something where it passes through and there's debt associated with that, those returns can be subject to a type of UBIT, which is UDFI, and they're calculated the same way. So the tax rate that you would pay is specific, isn't going to change whether or not you're looking at a debt finance income tax liability versus a unrelated business income tax liability. So this tax is applied to the profits, gains attributable to the debt that an IRA has invested in, or 401k potentially. Now, an IRA or a 401k can use non-recourse debt to finance the purchase of assets. Now, a lot of people, especially if you're on this call, will be more familiar with doing it just for real estate. But in reality, you can borrow money to buy just about anything. Although a lot of people, especially our clients and the people that come to us, are specifically looking for information and strategies regarding real estate, we have people that buy all sorts of different things with retirement plans. So keep in mind that I am very specific when I talk about utilizing debt to purchase assets, not just being real estate. Now, when debt is used by an IRA, the returns attributable to the finance portion are taxable. Now, this doesn't matter with an IRA if it's investing directly in real estate, so it bought a piece of tangible real estate directly. If it invested into an LLC or anything other than some type of blocker entity, such as a C Corp, any type of returns that have debt associated with it when an IRA is involved are going to have some type of UDFI liability associated with it. And again, there are some strategies around that. One of the more clever ones that I have seen is that if the debt is paid off before the end of the year, since you're using a rolling 12-month average, if the debt is paid off within that year time frame of when you're filing, then the average, by virtue of having a zero in it, would be zero when averaging everything together. So you might be able to utilize some strategies to help avoid that. But in general, if an IRA has any type of financing associated with its asset, it will have some type of debt finance income liability associated with it and will need to file 990T. Now, 401ks, and a lot of people are very right to kind of gravitate towards this, especially when it comes to utilizing debt financing for the purchase of real estate, are great because when you use a 401k, it will not be subject to UDFI for the acquisition of new real estate. Now, the IRS is really specific on this when they talk about UBIT, in that it has to be for the acquisition debt of new property. So now that does apply to limited partnerships. If it's passing through and they're using debt to acquire the new real estate, the exemption does pass through. But if the 401k plan wants to use a non-recourse loan to buy something other than real estate, let's say it wanted to buy a tranche of notes. Note investing is a fairly popular investment activity for a lot of people here. And if the 401k owner wanted to use that to buy up, let's say, a book of notes from someone, or a note investor that was looking to get out and just wanted to sell their book of notes, then if they had to finance that purchase, then debt finance income tax would potentially apply, even though the 401k is exempted from it on the real estate side of things. So keep in mind that the 401k exemption from debt finance income tax is not absolute. It has specifically to do with what exactly the plan is buying. Sorry, I just lost my train of thought. But that's essentially it. So keeping in mind that IRAs are always going to typically have to pay debt finance income tax unless there's some type of blocker entity used, or if there is a payoff of that debt within the first year of the acquisition, the IRA is going to have a debt finance income tax liability. And then 401ks, solo 401ks specifically, to what our clients normally utilize, would be exempted from the debt finance income tax, but only for the acquisition of real estate. So if you're buying something else, again, in my example, notes, then if you had debt utilized for that acquisition, then you would potentially be having to pay UDFI on that purchase. All right. And again, if anyone has any questions, feel free to type those in. We're going to get into a little bit more of the technical section. I say technical section, and this webinar is relatively technical in and of itself, with regard to case studies and kind of breaking down and showing what exactly this might look like. So if you have some questions that you'd like to ask, fire them away. I am more than happy to get those answered for you here before we get into a little bit more of the numbers portion of this. So if you have determined that you do have a 990T liability, you have to pay those by the timely filing deadline of the following year in which the liability was incurred. So, for example, this year, if you had some type of investment that gave off either a UBIT or a UDFI liability, you would need to file IRS form 990T, so that's 990-T, which is the tax return for tax-exempt organizations. You would need to file that by April 15th or whatever the timely filing deadline would be for that given year. Now, with COVID and all the things that we've had going on since the beginning of 2020, that definitely is a little bit more of a fluid point for the filing date. But just understand, if you file a personal extension, you don't necessarily get to extend your IRA's liability, your IRA's filing deadline, or your 401k's filing deadline for that matter, past the 15th. It has to be done within the timely filing window that the IRS sets. Now, UBIT taxes only need to be reported if the total owed is over $1,000. So if your tax bill grosses $1,000, you need to file 990T. If it's anything less than that, you don't need to worry about it. And one thing that I will emphasize very, very strongly, and it's not as much of an issue with solo 401ks, since when you establish a 401k, you almost always apply for a unique tax ID number for that plan, is that if you have a IRA that has to file for a UBIT liability or a UDFI liability, absolutely make sure that you apply for a discrete tax ID number for that IRA. Now, IRAs will normally use the custodian's trust accounting tax ID number for that. And while it's not necessarily incorrect for you to use that to file 990T for your IRA, here's some of the issues that I've seen with that. If, let's say, the calculation was determined to be you overpay your UBIT liability and there was a tax return being issued back to your IRA, the custodian doesn't necessarily use a unique tax ID number for each IRA account that it holds. So here at Advanta, we have almost 8,000 unique IRA accounts. If they send us back a tax return for, let's say, $500, and it just says Advanta IRA as custodian with our tax ID number, it takes months, and I've seen it take longer, almost the better part of a year, for us to track down and identify who this might necessarily apply to. Now, if you use a specific tax ID for the IRA specifically and file using that, if there is a return, or let's say that they've determined that you need to pay more, it is so much easier on you as the client and us as the custodian to make sure everything is done timely and you're not having to go through long, protracted processes with the IRS of all people. So if you're doing that, while I have seen some things online that say, do you need to have one for your IRA? Not necessarily. Personally, with my almost 10 years of experience doing this, it is something extremely easy to do. It doesn't cost you anything, and it will, if anything, it will save you a huge amount of headache in the future if you just go ahead and file under a unique tax ID specific to your IRA and don't use the custodian's trust accounting tax ID. Okay, we got a couple questions. So before we get into the next part of it, let's go ahead and get into these. Let's see. What is the actual percent of tax, and is it paid through the IRA funds or out of pocket? It is a tiered tax percentage, so it is pegged most closely to trust rates. So it can be as high as 38%, but depending on exactly how much how much income is subject to UBIT liability, it's going to bracket up from about 12.5% to 38%, depending on necessarily what it is. But if you look up trust rates, it's pegged pretty much exactly to that, and it is paid by the IRA. So when you file for a UBIT liability or a UDFI liability, 990T is filed under the name of the IRA. It doesn't go on your personal 1040 filing or any business filings. The IRA or the retirement plan itself files that separately, and it is responsible for paying that liability separate from you. Let's see. Okay. So in a multifamily syndication, separate question. In a multifamily syndication, I understand UBIT, UDFI do not apply during a refinance, but do during a sale. Do I understand this correctly? Well, it depends. I think there's a second part of your question here as well. If a cash out non-recourse loan is taken against the property already owned by an IRA and the proceeds are used to purchase a second property, would UDFI apply to the first property or the second property? Let's see. Am I making any invalid assumptions? Okay, sorry. These are two different questions. They got they got split up by two different people. So I'll read that one again. So the one from David, in a multifamily syndication, I understand UBIT, UDFI do not apply during a refinance, but do during the sale. So potentially, it's going to depend on a couple things. So if you're refinancing, the ratio of income to debt that you use to calculate a UDFI liability might change, or it typically would. So you would take the amount of, if the limited partnership is paying out revenues to the shareholders in a limited partnership on, let's say, a quarterly or an annual basis, and you're getting a K1 report back, the underlying debt to revenue ratio is going to change if you've increased the amount of debt on that property. So yeah, you might have a change. If they're not paying anything out, then potentially no. If you're not receiving any revenues and then it sells and then you just get a lump sum distribution back as a limited partner, then potentially yes, it might only apply to the back end of that particular deal structure. So it's kind of hard to say yes or no in that particular scenario as to when the UBIT liability is going to necessarily be incurred, or how much it's going to be or at what rate, because it's going to be calculated on a 12-month average of the debt in that particular deal. So again, a lot of kind of unknowns on that, but I hope that answers the question well enough. Let's see. Jeffrey asks, if a cash out non-recourse loan is taken against a property already owned by an IRA and the proceeds are used to purchase the second property, would the UDFI apply to the first property or the second property? Well, it's going to depend on which property is encumbered as to determining the taxable liability in that scenario. Typically, again, with specific questions like that, I would encourage you to talk to a CPA or an accountant. But when calculating a UDFI liability, you're looking at the encumbered asset that is spitting off revenue. So if one property is encumbered by something and then it has rental income coming in, the rental income attributable to that one specific property is what you're going to use for that calculation. Now, depending on how that goes and how long something's been financed and if there has been any income generated by that other property, let's say it's over a course of years or something, then, certainly there might be some liabilities due there. But again, it's going to be pegged typically, again, in the context of us having to kind of stay a touch vague on our answers on this, to the encumbered property, not necessarily the first one, if you then cash that out to a zero debt on that original property. Let's see. Okay, so Chris asks, UBIT due is $1,000 per account or $1,000 per investment within an account? It is the liability per the investment. So you could have an account with several different liabilities that are being spit off, that are spitting off cash that are subject to UBIT. And if, let's say, that the liability is less than $1,000, you could have 10 different accounts with a liability less than $1,000 and it wouldn't trigger it. Or, if the particular account had all those accounts, actually, saying it out loud, I would need to get some more research on that. If you would maybe email me that question, I can put a pin in it and see if I can find a direct answer for you, if you could possibly split those investments across multiple different accounts to kind of mitigate that. Interesting question. I always love to learn new stuff. So Chris, that's Perny at AdvantaIRA.com. So APERNY at AdvantaIRA.com. I'll certainly try to get an answer for you on that specific question. Okay. Now we've covered most of the information on this slide, but I like to put up the information just to make sure that people kind of have, if they are just kind of thumbing through the slide deck, at least have a reference point for it. So if you're using an IRA, here's some of the cons and drawbacks to using a solo 401k versus a 401k and what it might mean for UBIT liabilities. So the pros for using an IRA is that they're a lot easier to establish than a solo 401k, and everyone can qualify to have one. You don't necessarily need to have a business that you own or be self-employed in order to have a solo 401k. So anyone can get in and use an IRA. The IRA custodian does the annual reporting for the underlying assets. You don't need to validate it like you do with a 401k. Now you can use blocker entities to limit UBIT or UDFI taxes, namely it's the use of C corporations being elected to be taxed at the corporate tax rates instead of passed through to the end user tax rates, or what are going to kind of help you reduce or block UBIT liabilities coming through. But of course, that means you do have to elect to pay taxes anyway, and you don't kind of have an automatic exemption like you do with the acquisition of real estate for 401ks, which is a very nice benefit to being able to use a 401k, is not having to worry about a blocker for every scenario. But again, if you are into something that is going to spit off a UBIT liability specifically, so investing in a trade or business that is a non-C corp, then 401k might have to use a blocker liability as well. So some of the cons for the IRA, subject to UDFI tax on leveraged income. You can use depreciation and deductions to offset the liabilities, and I'll show you that exactly kind of how that works in the case study we're going to get to of investing in a syndicated deal with an IRA, and show you how that kind of differs from a 401k specifically. The profits at the end of a deal, depending on how much they are, and it doesn't need to be super huge. Obviously, it depends on your underlying investment basis. If you make over about $12,750 of profits, you might be taxed at 37% to the IRA. So that can be a fairly substantial hit to take if you're going to be investing in, again, something that is either a trade or business or has debt financing associated with that. And again, you're more likely to have to file a 990T, which is going to be an extra cost and burden associated to the IRA. Now, some pros about using a 401k. They're not subject to UDFI on income related to leveraged real estate. And at the end of the day, I would say most people are mainly concerned with debt finance, the debt service spitting off a taxable liability to their tax shelter through a 401k or an IRA. And the nice thing with a 401k is you don't need to use any type of blocker entity or anything else like that. If you're investing into something that has debt strictly for the acquisition of real property, then it's just an automatic exemption. You don't have to file anything, it's just automatic, which is very nice. Very few things when it comes to referring to any type of taxation are just going to be automatic with regard to dropping a liability. So that's a very nice point. Checkbook control can be adopted just by leasing plan documents, so you have a much greater flexibility on how you administer 401k plans. You can accept rollovers from IRAs and old 401k plans directly into these. Or if you don't necessarily have one, the 401k is a great place to start if you're looking to acquire a rental property portfolio by using debt financing. So if you qualify for the 401k, if you have a self-employed business activity, or you're self-employed with an LLC or something, you can use that and then use the 401k to debt finance the purchase of real estate without having to pay UDFI or UBIT liabilities. So it's a great place to kind of start from the ground up, as opposed to an IRA that would have those liabilities associated with that. And 401ks have a significantly higher contribution limit to those types of plans as opposed to IRAs. You can contribute $6,000 or $7,000 to an IRA annually just out of your own pocket. With a 401k, you can contribute up to $19,500 of your income deferred into the plan per year, with an additional $6,000 if you're over 50 and a half, plus a portion of your net operating income as well, which is 25% of your NOI to the plan, not to exceed $37,500 per year. So significantly higher contribution limits to 401k plans as opposed to IRAs. But again, you do have to have some qualifications for them and to be able to take advantage of some of those nice exemptions from debt finance tax. The cons with that, again, you need to have a valid sponsoring employer/business, so you can be self-employed. It can be an owner-operated business, but you do have some restrictions there. Once you get larger businesses, they're a little bit more complex to set up and utilize, especially on a very micro investment level with regard to real estate for you specifically. You need to be able to make valid contributions. Depending on the size of the plan, you might have additional tax reporting that might go along with it, called 5500 EZ, to report values and contributions to the IRS. And then as the trustee of the plan owner is responsible for all IRS reporting. So if you are acting as the trustee of the plan, you have to sign 990T. Not only do you have to have someone prepare it, then you're the one filing it. And if you have multiple participants in that plan, you are acting as the plan fiduciary, and that can be a little bit cumbersome and may not necessarily be a responsibility that everyone wants to take on. So I don't like to scare anyone away from utilizing a solo 401k. They're hugely beneficial plans, especially to small business owners or people that are especially looking to avoid paying unrelated debt, finance, income tax. But they aren't just as easy as opening up an IRA. You do have to have some qualifications to it, because at the end of the day, if you want to use it just for helping you avoid UDFI tax, but you didn't necessarily qualify to have one, that's a whole other kind of animal that you're getting into with some bad situations with potentially the IRS and maybe even the Department of Labor if you didn't qualify for establishing the plan in the first place. So again, some pros and cons for each one, kind of just showing where you can demarcate the benefits and the downsides to each. We're about to get into the case study, which will kind of get into some nuts and bolts numbers of what an investment might look like with how the liabilities pass through. So if you have any questions, now's a good time to get them in, and we will get hammering on this case study. Okay, we have to go back and just got the slide a bit out of order. So in this case, Jane wants to invest in Rocky's deal. She has a $100,000 IRA with Vanguard. She meets Rocky, who has a private offering to purchase and remodel apartment complexes. So, for those of you who aren't familiar, this is what typically people refer to as a syndication. He's raising capital in order to purchase these apartment buildings that are going to be renovated, rented out, and the like. So she's going to be coming in as a limited partner with her IRA. So she opens up an IRA account, she completes the application to have $100,000 moved over from Vanguard, and then we submit the request to have everything pulled over to us and invested. Now, what does the investment process look like? Fairly straightforward. Again, this is all kind of the easy stuff. The more complicated back end of figuring out UBIT liabilities definitely comes later, but at least the initial setup is relatively easy. So in this process, the account manager that we have here at Advanta works with Jane to get the investment paperwork done correctly. We look at the subscription documents. That can be everything from just a regular subscription agreement to an LLC schedule to a full long form PPM. We don't necessarily have a preference as to what exactly is being provided with us or whether or not it is qualified under one of the regulations of the Jobs Act, such as a Reg D filing or anything. At bare minimum, we just need to be provided with the paperwork showing the actual investment being done for the IRA or 401k if we're acting as the TPA for the plan. So the subscriber's name is Advanta IRA for benefit of Jane Smith IRA. The tax ID is Advanta's trust tax ID, not her social security number, unless a unique one has been applied for. And in the case of if you know a UBIT liability is going to come up from, or a UDFI liability is going to come from the actual investment, might not be a bad idea to do at the beginning. But again, it doesn't really cause an issue if we have to do this later. And then going forward, quarterly distributions of $2,000. So $8,000 per year are sent back to the IRA. So Advanta receives in total $8,000 per year relating to this $100,000 investment. Jane account gains are not included in her personal income, but they are included when factoring in a potential UBI or UDFI liability. So now let's look at we have a kind of a spreadsheet coming up next, but we'll look at it in this context right here. So if the project is 70% leveraged, then 70% of the income of the quarterly distributions payoff is returned and subject to UDFI or UBIT tax. Now, the assumption is, and at least in this one, that it's just going to be an interest-only note that is being paid. If it's principal and interest, the amount of leverage is going to decrease over the life cycle of the investment, and then if eventually it is paid off, UBIT would no longer apply because the deal is no longer subject to financing or any type of UBIT or UDFI liability. But if it's an interest-only note, which in this scenario it will be, then keep in mind that there's going to be no change in the scale of how much UDFI liability is going to be owed. So the IRA receives a K-1 from the syndication showing the income and allocations. The interest income is exempt from UBIT, but any type of return on the principal is going to be assessed a UBIT liability. So you could use a C Corp to block it, 21% corporate tax rate instead of 37% UBIT. But really, which one's going to be the better deal for you? If you're going to have to be paying a CPA to do a corporate tax return, is that going to really eat into the potential for that 21% versus 37% savings to be applied? And also depending on what type of pass-through deductions may or may not be able to be captured by a C Corp is also something to check with the CPA about as well. So in this scenario for paying UBIT, the IRA files IRS Form 990T and can deduct a percentage of expenses, cost segregation, and depreciation. And you also get a $1,000 deduction automatically for anything that does have a UBIT or UDFI liability. And if I'm using UBIT and UDFI a little bit interchangeably here, I do apologize. For this specifically, it is UDFI, but I like to make sure that people understand that the same application of filing applies to UBIT. So with that said, the UDFI automatic $1,000 deduction also applies to UBIT. UBIT tax is paid at trust rates, and it tops out just at around 37%. Tax is paid by the IRA and does not show up on the individual's personal tax return. And losses can be carried forward if 990T is filed. So you have to be filing 990T to carry over a loss from a previous year. And solo 401ks and qualified retirement plans don't pay UDFI tax so long as it is acquisition debt for new real estate. If you invest in a syndication that is using debt to then in turn acquire other entities that maybe own real estate, that may not necessarily pass through that exemption. You would need to check with a CPA because not all deal structures are going to be treated equally in this scenario. Greg asked, what do we charge for filing 990T? We don't file 990T for clients. We are in the process of getting the workflows to be able to do that, but presently we do not offer the service of filing 990T, but we will certainly put out a press release and notify all of our clients and contacts once that does become an available service that we do. But typically, since it is something that you need to have some fairly in-depth accounting work like that, finding someone that is familiar and has done 990T work specifically. You can look at people that do filings for any type of charitable organization. So think about CPAs that work with churches, charities, non-for-profits, or one that does specifically works with IRAs, and there are several out there. But those are the people that are familiar with 990T and can help you out with being able to file correctly for that. So those are some resources that I would say look at since it's not a service that we provide directly to our clients. So here's kind of the UBIT liability on this investment. And keep in mind that in this investment, assuming all else being equal, a solo 401k would not have to pay any of these taxes. So keep that in mind if you're looking at maybe doing something like this where you're investing in a debt finance syndication. Here's the impact of UBIT or unrelated debt finance income tax on a $100,000 investment. So year one, total annual income, 8% return is $8,000. The amount of income subject to UBIT here is going to be 70%. And again, in looking at this scenario, we are now assuming that there is a reduction in principal being paid on the note. So in this case, $5,600 is what is going to be the income subject to UBIT. So 70% leveraged, $8,000 total return. The automatic deduction per year is $1,000. So the deductions, cost segregation, and the accelerated depreciation is greater than $5,600. So there is zero taxable income and zero unrelated debt finance tax due that year. So first year wouldn't have mattered if you use a solo 401k or not. It still returns $8,000, even though there is debt financing associated with that particular investment. She's asked, example of deductions, perhaps some renovations to the property. Yes, perhaps. Things like renovations, depreciations, cost segregation analysis on specific portions of the actual property. There's, you know, the improvement of a property is going to generally be considered a deductible expense for an investment property. So yes, typically, but you're going to have to check with someone familiar with being able to identify specific write-offs for this as to, you know, what may or may not apply in that scenario. So while I wouldn't necessarily say a blanket answer of yes, the potential is there definitely for that to happen. So again, no change in the amount of money being returned, still $2,000 per quarter, $8,000 total. Now, there's been a, the amount of income subject to UBIT is now less because they have paid off some of the principal of this note. So $4,800 is the taxable amount that we're looking at for this second year. Get an automatic deduction of $1,000. Now deductions, cost seg, and accelerated depreciation category is only $1,000 this year. So we get to wipe out $2,000 total of the $4,800 of subjected debt finance income tax revenues. So now we have a taxable income that we have to look at of $2,800. That falls into the 24% tax bracket for filing a UDFI liability for the trust rate. So this year, because we didn't use the 401k, we had a total investor return of $7,328. So not too terribly bad. While looking at this, of course, if you scale that up, it would be significantly worse. Now, year three, we have $8,000. Again, we have that $2,000 per quarter, so $8,000, and then we have $20,000 returned to the investor of profits at sale. So she received back her $100,000 plus an additional $100,000 of basis plus $20,000 of profit at sale. So the amount of income subject to UBIT in this case would be $14,000. $1,000 annual deduction, automatic. Deductions, cost seg, accelerated depreciation is $1,000. So we have $2,000 we can wipe out. So $12,000 is what we're going to be looking at for the total of taxable revenues for this year. Now this one, it definitely starts getting steep. So you have $4,200 tax liability that you have to pay on 990T in that third year after the sale of the property. So the investor receives back $23,800. Now in total, throughout this 3-year investment, the investor has paid $4,872 of UBIT tax. They got $3,000 of automatic depreciation. They were able to take advantage of $7,600 of deductions and cost seg, but in total they had $14,800 of taxable income that they had to pay $4,872 of tax on. So unfortunately, instead of being able to capture all that, which they would have been able to do with a solo 401k, the IRA investor got to take home $39,128. But keep in mind of the context of this is that even though there was a fairly significant amount of taxes that had to be paid, any of the returns that are being paid to that account can automatically be reinvested in things that maybe don't have a UBIT liability or have any income tax liability as well, and help to create longer term compounding interest for that particular account. So while yes, this one specific investment is spinning off a tax liability associated with a tax shelter, the IRA, it's not necessarily appropriate to look at saying, oh, well, I'm just getting, hammered with taxes on this. All those returns are still going back in to some type of tax shelter, and it's not going back to you personally to where your next investment's going to have a tax liability associated with it. You can certainly invest in other things that don't necessarily have that liability associated there with it. So with that said, that's the end of the presentation. I'd like to open up to questions and answers. I know we can't specifically dive into some of the more specific items that some people had questions on, but I am more than happy to answer questions to the best of my ability on this If you would like a copy of the slides, the presentation is attached as a PDF to the handout section of this presentation. If you have any questions that you'd like to ask me directly, I can be reached at my contact number of 727-754-9954 or aperny@advantaira.com. Again, we're always happy to answer questions. Use this as a resource to call first before you maybe bounce a question off a CPA or an attorney and save yourself a few bucks. But I'll hang out here. We still have about 55 people signed on. Once we have about 20 people on, I'll go ahead and end the call for everyone. And then this presentation will be up on our YouTube channel probably by tomorrow afternoon. All right, looks like we have pretty much most people signed off. Again, let's see, DW, this is not necessarily a CPA qualifying course, but if you will send me an email, we can generate a certificate. And if your particular governing body accepts that, we are certainly happy to do that. And Sean, the PDF of the slides is attached as a handout on there. Okay, looks like you found it.